All right, and welcome to today's Monday morning rate update. So let's jump right in. So first off, I've talked a lot about this, and this is the government versus the Fed. This is the fight versus government spending of the bonds, trying to raise money for the things that they have allocated to spend on, and then the Fed, which is trying to bring inflation down. And the reason I say government versus the Fed, this is on the mortgage side. So the Fed is actually helping bring inflation down, which brings mortgage rates down. But the government is selling bonds and they're flooding the market with bonds, which is making them, well, it's basically the game of supply and demand. Just like real estate, if there's way too many homes and not enough buyers, what happens? If there's oversupply, prices come down, they're not worth as much. That's what's happening with bonds right now. And I'm going to show you a little bit about what I'm talking about there. So we have the government versus the Fed right now playing a tug of war. And that's what we're going to see in what's in the mortgage rates in them, as far as, are the mortgage rates going to continue to come down, or will there be a back and forth, kind of like what I was talking about last week and the week before. So let's have a look. So first off, bond auctions. This is how the government makes money. They create bonds, they sell the bonds to the public, to investors, they get the capital, then they spend that capital. Basically, they're putting everything on a credit card. Easy way of saying it. So this is a tweet from the Wall Street Silver. This is a big Wall Street individual that is talking about kind of what happens with the U.S. debt. So it says, yesterday, U.S. Treasury, the U.S. government tried to borrow $24 billion by selling a bunch of 30-year debt. So basically, it's a 30-year bond. You can buy it, you get a return of 5% or whatever for 30 years, and that's your return. And it's a 30-year bond. And it was a huge disaster. In order to get enough people to buy, the rate had to be dramatically increased. So to make this bond more attractive, nobody wanted it. So they had to increase the yield on it. It's like saying, hey, I'll give you 5% if you give me 100 grand. And you're like, dude, 5%? No. I'm like, well, okay, 5.5. What about 6? And so finally, they upped it until people said, finally, yes, I'll buy it. That's a good yield. So they're driving interest rates higher by selling bonds. Not a good thing for the mortgage-backed securities, because guess what? Mortgage-backed securities, they are bonds. So also China, Japan, Saudi Arabia, Russia, none of them are buying our debt anymore. They were some of the biggest buyers of our debt across the board. So here's just some articles that I saw. 30-year Treasury auction breaks bad, sinks stock market, the cracks in the U.S. Treasury bond market, bond supply fears reawaken. Treasury bond auction has been ugly lately and weak demand. America's biggest bond buyers aren't buying. JP Morgan is worried about who's going to buy all the bonds. The most powerful buyers in treasuries are all bailing at once. This is our bond market. This is where the government raises money. We have a lot of bonds coming up, a lot of bond auctions coming up, and this is not a good thing for mortgage rates. So we've got the bonds, and then we've got inflation. So inflation is coming down, or it's better than it has been, but the Feds are working really hard to bring that inflation down. So let's look to see what's happening with inflation, because this week, tomorrow, is the CPI, Consumer Price Index. So that's the biggest inflation piece of the month. So let's look to see what we're going to see tomorrow. So September, the core year over year was at 4.1. Some predict it to be up at 4.2, the Cleveland Fed. The consensus overall is that it's going to stay the same. MBS Highways, which is mortgage-backed securities highway, they gauge things differently. They think it's going to come down a little lower, and that's because of shelter inflation. So shelter is the one that's lagging. And last month we saw a little bit of a spike. So it was not a good thing. So last month we saw shelter inflation actually spike. These are rents. These are new rents. So we actually saw that spike. So we think this is more of an anomaly. A lot of people think that this is going to come down and we're going to see inflation get a little bit better. So with all these bond sales, and with inflation supposed to be the same or better or maybe higher, what are we looking at right now for mortgage rates? So here's today's bond market. Today we are down 24 basis points. So let's look over here, let's look down here on the candlestick chart. We hit back in the middle of October, we hit a low down here in the bond market, and then we saw a rally. And this is where you started to see the all of the rates get better. The bond market improved. And it improved last week, 2 weeks ago, in a big fashion. So we saw from down here, 98.5 all the way up to 101, we saw 250 basis point improvement. That was about a half to 3/4 in interest rate. But then we lost last week, we lost a lot. We lost 100 basis points. So rates are still better than they were 3 weeks ago, but they're not as good as they were last week. So again, that tug of war I'm talking to you about, when the bond auctions happened last week, it really soured this rally that we had. Mortgages, they're bonds. So if nobody wants them, no one wants to buy them, value goes down, and that's not good for bonds. So here's the 10-year. The 10-year, we saw it come down, and we started in this range, which was great. We're going to see this go down because when the 10-year goes down, guys, mortgage rates go down. So it went back up again last week. So it's trading higher today, which is not a good sign for mortgage rates. So let's look to see what actually happened with mortgage rates. So last week when I did the presentation with 30-year fix was just right around 7.6. Right now we're closer to 7.875. The same terms, the same number. We're about a quarter higher in interest rate as of right now. This is week over week. So with what's happening today, the end of business day, this should be a little bit higher, most likely. Hopefully we'll get some good news with the inflation tomorrow. And that is going to be interesting to watch. So it's going to be a very, very volatile week. We have bond auctions coming up as well. Check out all these bond auctions that are going to be happening. So the government sold off last week. We had 75 billion and 68 billion. What is that? 1.3 trillion? No, I'm sorry. No, that's not. That's 100. Yeah, 1.3 trillion. Or is that 130? My math is off again. 130 billion, right? Crazy. That's how much we sold in. So yeah, 130 billion roughly in bonds that we sold last week, and it didn't go well. So this shows the upcoming auctions as well that are going to be happening this month alone. So, and this only goes through the 20th. I didn't expand it. And then you might want to say, well, how did it end? How did it go? Here's the actual results. So it started in this one right here, it started at 5.29 offering at the high, but people wouldn't buy it unless they raised it to 5.4. Started at 5.28, they wouldn't buy it until it was 5.418. It started at 5.285, they wouldn't buy it unless it was 5.446. And one of the interesting things about this, the bond buyers, there's a select group of them that if nobody's buying them, the feds or the government forces them into purchasing them. So they give them at a higher rate, but they force them to buy them. So it's really interesting how these bond auctions work. So let's see what's happening this week. Again, tomorrow Tuesday, we've got the consumer price index. And then on Wednesday, we have the producer price index, which is different. This is the consumer. What they're buying, is it more than it was last month? And the producer, is the production of goods getting more costly month over month. And then import price index is another inflation. Are importing items getting more expensive overseas, or is that going down? And then on Thursday, we have continuing jobless and initial jobless claims. So this is going to be a very volatile week. I don't envy buyers, because this means if you're getting a rate quote on Tuesday, it could be significantly better or different or higher or lower on Wednesday or Thursday, just because of these different things that are happening in the markets. So it's going to be a very, very volatile week. I'm going to share right now. I'm going to switch gears a little bit. We had a special guest that was going to come on with us today to talk about assumable mortgages. So I'm going to shift gears real fast. I'm going to show you their website, and it's called YouMe, and I think it's a really funny website because if you look at it's assumable mortgages, and if you look at the logo, it's an ass, which I think is hilarious. And then UME, assume. So not a lot of people get that right away, but this is their website that they're creating and they're starting. And I know the owner of this company. They are local to Arizona. They have what's called a certified agent, and you can get on this certified agent list. And then this website is going to show all of the listings in the area that have assumable mortgages, what the payments are going to be on it. And if you click on one of them, it'll give you information on what the assumable rate is. Assumable mortgages, guys, are a huge tool to have in your arsenal. So I'm going to take this away for a second and stop sharing my screen for a second, and share with you this. Assumable mortgages, guys, if you have anyone that is unable to buy right now because rates have spiked. So all of those buyers you had 2 years ago that right now they just can't buy anymore because they're now outside of that realm. Assumable mortgages may be an opportunity for them to purchase because you get the house and you get the rate, and it's all FHA and all VA loans are assumable. So all FHA and all VA loans are assumable. Now, some may say, well, what about conventional loans? There is a very, 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 very small percentage of conventional loans that is assumable, and that's on adjustable rate mortgages that are conventional. So owned by Fannie and Freddie, that are adjustable rate mortgages that have already gone through their fixed period. Meaning, if it's a 3 or a 5 year arm, they've already been through that 3 years and 5 years, and now they're on the annual adjustable cycle. Those are assumable, but there's a lot of red tape on those. So in a nutshell, only VA and FHA is assumable. Now, some things to know about this. And again, Rachel's going to come on next week. We're going to have her explain all of the details regarding being a certified assumable property specialist, kind of like the old short sale specialist back in the day. It's going to be assumable mortgage specialist on the real estate side. But when you have a VA seller, okay, if they have a VA mortgage and they want to let that be assumed, somebody can buy that as an investor. So you can buy investment properties and assume that VA loan, or a primary residence or a second home. You can do that. Now, if you're a veteran selling a home and you let somebody else that is a non-veteran assume that mortgage, they don't get their eligibility back for whatever they've used. But let me tell you something. Let me show you something that's very, very clear. If they had a $300,000 VA mortgage, and that's what they used, that was their original balance on their loan was $300,000, and they let somebody assume that loan, they still have their secondary eligibility amount because they can go up to the maximum conforming loan limit at 100%. So follow me on this. If they've used $300,000 and that's the loan that they're going to let somebody else assume, they now have the remaining difference of $300,000 and $750,000, which is now $450,000 still left on their VA eligibility for 100% financing. So now let's just say they have that $450,000 but available, but they want a $550,000 house. How can they buy the next home? Very simple. They can do 100% financing up to $450,000, and then that extra $100,000 that they need to bridge the gap on, VA will actually fund 75% of that. So they would then bring in 25% of the difference, which in this case is $25,000, as the down payment, and they can buy a $550,000 home. So if you have a veteran that is afraid that letting them somebody else assume their mortgage will not allow them to buy another home, they are mistaken. And I would love to help you guys with that. If you have a listing for a veteran that has a VA loan, to help them sell their home, because VA or assumable mortgages, homes with assumable mortgages are selling a lot faster than those without. So it's a good selling point, and that people just need to know the rules behind it. One super important factor is when you let somebody else assume your mortgage, they take on all of the liability. It can never come back to you. If they miss out on a payment, if they go into foreclosure, it's not going to impact you. I want you guys to understand that. Now, FHA is a little different. FHA is only available to primary residence borrowers. So buying a home is a primary place to live. VA can do investments in second homes. FHA is only available to primary home purchasers. Now, FHA also has monthly mortgage insurance. So the rate may look good at, let's just say 3.5%, but it does have mortgage insurance regardless of how much you put down. Now, let's do a quick example. Let's just say a home is worth or selling for $500,000 and it has a VA assumable loan at $410,000. That would mean that there's a $90,000 gap there between what it's selling for and what that assumable mortgage is. The buyer would have to bring that in or get a second mortgage. So lenders are allowing to get a second mortgage up to 90% of the purchase price combined liens so that you can put 10% down and do a first and a second. So there's some really creative ways that are out there to help purchase and bridge that gap when you're doing an assumable purchase. So I want to open this up right now to questions. So if you're in the chat, please jump in and let me know if you have any questions on assumable mortgages, because there's a lot of really bad information out there as far as what is an assumable mortgage, what are some fears of assumable mortgages, and I've got you guys all here on a little grid here, so you're going to be on the spotlight. But if you have any questions on assumable mortgage, oh, does it require 2 appraisals? Guess what, guys? They don't need any appraisals. There's no inspections needed and there's no appraisals. So another great way to entice your sellers to do okay, here's a good example. Okay, follow me on this. Prescott people, Phoenix people on the outlying areas, let's just say you've got a manufactured home that is an FHA loan and you want it to be, you can sell it and have somebody else assume that mortgage. Let's just say the owner just decided, I'm not doing anything to the house and it needs paint. It's got paint peeling. It's got a deck on the front that's falling apart. It's just got some problems. And you know, if it had an appraisal, it would not have a good day. Because they don't require an appraisal, you can now sell that without needing an appraisal at all. So if you have any ugly properties that have FHA, you can now sell that with an assumable mortgage and not require an appraisal that would stop that property from being sold in the first place. So keep that as a note. Assumable homes with assumable mortgages do not require an appraisal. Now, would you want to get an inspection? Absolutely. Absolutely, you would want to get an inspection just to protect your buyer. But the average, I would say I have a question here. How long does it take to do assumable mortgage? By law, 45 days is what they have to perform as a servicer on an assumable mortgage. That's by law. Now, are they following the law? No, but you can kind of hold them to them. Now, Rachel, my friend who owns the Assume or the Me website, which is takemylowrate.com is the domain, takemylowrate.com. So write that down. She acts as a processor for you on assumable mortgages. And now she's going to speak next week. She's going to go over all of the ins and outs of this. But if you have one, don't pretend to know what you're doing, because you're going to see landmines everywhere. She's been doing it a long time. She's really good at it. Kind of like a short sale processor back in the day or a short sale manager. This is the same thing, but now with assumable mortgages. So it should take about 45 days. Again, lenders are new to this. They're going to try to find ways of sabotaging it, but just stay strong. Would the second mortgage be at the current mortgage rate? Yes. Good question. So if they're getting a second mortgage to bridge that gap, it's the current rates. You would adopt that first mortgage that's assumable at the lower rate of, let's just say it's 2.75, and then the new rate at, let's just say it's 7.99. But the blended rate, if you assume them together based on their balances, the blended rate kind of averages it together, is still significantly better than anything you can get right now. Yeah, VA with no appraisal. Debbie, you had a question?
Yes, somebody said that if somebody assumes somebody's VA and they do foreclose, that it affects the veteran that had the original loan forever for his eligibility. Is that true? You know,
Probably not. So that eligibility is used up, but and I think I did a little research once we talked about this the last week. If they've assumed a VA mortgage and that VA mortgage is like 300,000, they foreclose and the property sells for 350, that VA is still being paid off. It's not going to go into default. The
right.
late payments and everything that's going to be on that is going to be at the liability of that new borrower.
Okay.
So that they don't get penalized on that. If they lose out and it's significantly lower than the original loan balance, they will be reinstated for whatever's left there, but the previous buyer would be liable for that. Good question. Assumable mortgages are great, guys. The problem is that I'm seeing is the gap in between. So there's some buyers that may not have the down payment, and that's where begging parents, trying to get a cosigner or somebody in there to help with the down payment, or trying to get a second mortgage to bridge that gap is going to be important. Does the second loan have to match the assumed loan, or can it be conventional? Yeah, the second mortgage can be a typical like home equity line of credit or HELOC or fixed second mortgage. It can be that. It doesn't have to match. Correct. So it's going to be a traditional, and like any type of a second mortgage that you would get nowadays for any other mortgage. The assumable listings on some of these new websites seem illegit. When we look up Monsoon, the FA. So not a lot of people are posting that they are eligible. So on the website, if you look on the website, if it says verified, if there's a check mark that says verified, then it has been verified that truly is a assumable mortgage. All of the other are based on the deeds on the property on the time that they were closed. And she's going through these every day and updating this and calling all of the listings that hit the market to see if they are assumable or FHA or VA. So good question. Very good question.
Is she doing that in Prescott also?
I don't think so right now. They are. It's brand new to the Maricopa County area, and she is going to be expanding it to different areas. But for now, the test phase is here. But good question. I'm sure she will, because there's going to be a big need for this. As people get priced out of the market because of appreciation and because of rates going out, this is a great opportunity for them to see if there is something that they can jump into, an opportunity for them to get a home at a much lower rate. Now, I can't help with these guys. I can't do the mortgages on any of these. So I'm going to be on the sidelines watching you and your buyers get much better rates. But I think it's important for me to let you guys know, to make sure you guys have the upper hand and have this as a tool that you can use when working with buyers to make you look better than the other agents you're going up against. So if you have a potential buyer, this is something you can talk about. If they're a buyer that's already pre-qualified with me, by all means, still let them know that this is an option. Because if they can get into a much more expensive home than what they're qualified for now, go for it. So here's an example. Let's just say I came to you, and Debbie, I'm going to pick on you for a second. Debbie, I came to you and I got pre-qualified through this goofball named Sean Woolen. And he told me that I am qualified for a $350,000 purchase price. I can do 20% down, but that's all I can qualify for. And really, nothing in that price range is appealing to me, so I'm just going to wait. Now, if I was you, Debbie, I would say, no, let's find an assumable mortgage that we can get with rates in the 2s and 3s, maybe 4s. And if you have 20% down, we can get one at X amount of, assumable mortgage at 400,000. And now you can qualify, because it's a lower rate you qualify at. Now you can qualify for 450 to 500,000. Now you're in a much higher price bracket. See how that works? Because you qualify at that lower rate, you're now pushing a 350 buyer that maybe couldn't qualify, or the stuff they qualified for just sucked. You can get them into a much higher price point at the same payment. So look to that as an opportunity if you do have those buyers that are just going to wait and put on the brakes because nothing that they're seeing is really going to be appealing to them. I mean, they may be in the 700 category, but they wanted to be in the $1 million. There's VA assumable mortgages guys that are up to $2 million on loans. Remember, VA doesn't have a limit. So there's some VA assumable mortgages I've seen in the $3 million range. And you could do $250,000 down and assume a $3 million mortgage. So don't think it's just for the lower end. Anyone in that world can assume a mortgage. So it could be a $700,000 VA loan, and you can have somebody in the 900 price point elevate to 1.1 million because of it. So just keep that in mind, guys. These are really a good thing to know about and understand so that you look better and smarter and brighter than the other realtor that you're up against. Now, everyone on this call, hopefully you're not up against each other because you're going to have the same smarts. But I think it's great. It's a fantastic way to at least look like you're better than the competition and have that extra edge.
John, could you and the lady that's coming on next week kind of write an article that we can put in our newsletters or get out to our clients? That
Absolutely. Now, because she's the expert, I'm going to have her do it. It'll come from a better, I think, more powerful of a position. And but I will help endorse it, and absolutely. Absolutely.
I think it could be a win-win, because if it doesn't work that way, then we can get them back over to you.
Yeah. And there's pros and cons that have to be talked to the actual seller. They need to know the pros and cons of it. Do all VA and FHA assumable mortgages get approved? Not all. It's kind of a tug of war, a battle with the servicer, because servicers, they're not loan officers like me that are trying to close things fast. They are, an online loan officer that got thrown into the bucket that said, okay, you're our call center loan officer. Now you're going to be our assumable mortgage guy. And they don't know anything. And a lot of them have only been in the industry 1 or 2 years. So you have to deal with that, and you just have to persevere. So it is a great option.
Servicer does the second also, correct?
They can, or we can do them for you.
Oh, so you can do the second.
Yep, we can do the second, or we can have it, or somebody else can do it. Anyone can do the second mortgage. Now, does the servicer offer it? Maybe you can do it all in one swoop. It's probably simpler to do it that way, so you don't have 2 lenders involved, but anyone can do the second mortgage.
So you can do your second in 30 days, and they're going to take 60.
Yeah, exactly. So it's going to take however long it takes to do the first.
Some working together.
Yeah, exactly. Does a primary owner need to qualify? The one who lives there? It depends. So if you're doing it as an investment property, not always. If it's an FHA, good question, because FHA requires that the primary borrower qualify on their own. They can have co-signers, but they don't underwrite these like a normal automated underwriting engine would. So your pre-qualification you get from a lender doesn't mean squat. It doesn't mean anything, because if I run it through DU, which is Desktop Underwriter, Fannie Mae, or Freddie Mac's LP system, Loan Prospector, and I get an approval, it doesn't mean anything because the rules are different for an assumable mortgage. They would do what's called a manual underwrite. So if you've ever done a manual underwrite, it's a lot more strict. There's things like verification of rents. They don't let co-signers help qualifying. So the primary borrower living in it as their primary mortgage will have to qualify on their own with their own income. And then the co-signers can help with assets. So very good question. That's one of the biggest differences in these assumable mortgages. Man, I can teach this class. We don't need Rachel. I can just do this on my own. I'm just kidding. But she'll be out here next week to talk about her website, and probably would want to put 60-day COE. Yes, and most sellers know that it's going to take a little bit longer on an assumable mortgage. But here's the question. If it sells in a week because it has an assumable mortgage, or it sat on the market for 90 days and then took a 30-day close. Which one was faster, even with the 60-day close? So it still could be quicker to do a assumable mortgage than put it on the market and wait and have price reductions, and then sell it. Also, a lot of these are selling at a higher premium because people want that lower rate. So as a listing agent, I want you to really keep that in mind. So don't shy away from the assumable mortgage part of it.
Sean, will you put the website in the chat?
Yeah, www.takemylowrate.com. And if you aren't comfortable talking to your sellers about it, Rachel, and I'll introduce you guys to her next week. She'd be happy to interact with your buyer as basically a processor for you and together with you on a conference call to go over everything in detail if you don't feel comfortable doing it. So just now she does have a fee. The buyer pays for the fee, or you can ask the sellers to pay for closing costs and have them pay for it. But there is a fee that they do charge the buyers, and believe me, it's wealth it. Yes, she actually is a lender. She is a loan officer, one of my peers, but she also has this product, and she's a friend of mine. We play pickleball with each other. So she's a licensed loan officer, has been for a very, very long time. So she already has this built. I started kind of going down this. I created a Facebook page called Listings with Assumable Mortgages. And then I ran into hers. I'm like, well, I just need to join forces with her because she's already done it. So I'll let her get the glory on that. But yes, if you have any questions on anything like this, any assumable mortgages questions, she's gonna be on here next week on Monday. And we had a lot of good questions here. Start writing down the questions that you have so we can address those next week. And how do we know if it does qualify to be assumable? Any FHA or VA loan is going to be assumable. Any of them. Any FHA, any VA is assumable. See if there's any other questions I missed here. And there's a lot of bad information in the MLS. No conventional loans. Most of them are not assumable. How did you not already have that domain? Yeah, very funny, Melissa. Very funny. I think that's all the questions that I answered. If there's any further, I will stay on the line, and I look forward to seeing you guys and learning more about this next week so that you guys can be experts and dust off all of those people that couldn't qualify. Maybe first search to see what is available. Maybe call Rachel. Her contact information should be on the website. If you just click the contact us button, it'll go to her. Let her know I sent you, and we can be off to the races and help some of our buyers that are priced out of the market, or help them elevate their price range to a little bit higher, the price range that they actually want. So thanks again, guys, and hope you have a wonderful Monday. And please confuse it. Oh yeah, it's not a wrap, and we can talk about that. But yeah, definitely not a wrap. But this is a wrap. We're done. See what I did there? Oh boy.
Bye, Sean.
All right, guys.
Bye, Christy.
Have an awesome week. We'll talk to you guys soon.
Bye, guys.
Bye.
That's a wrap.
That's a wrap.
That's right, girl.
Mm.